Okay, if you've ever dipped your toe into the world of personal finance, you probably know that feeling.
Oh, yeah. Like instant overwhelm.
Exactly. Paralysis, almost. Everyone's throwing around acronyms, stocks, bonds, ETFs, MFs.
hmm
It seriously feels like you need a finance degree just to figure out where to even start.
It really does. And our sources, they confirm that complexity. It can stop you cold before you even make your first investment.
Right.
But here's the thing. The fundamental truth is that pretty much every solid portfolio, no matter how big or small, is built using just 4 basic tools.
So that's what we're doing today, a deep dive into those 4 essential investment building blocks.
The DNA of your portfolio, basically.
Our mission here is simple. Cut through the confusion. We want to clarify the core differences, risk, return, cost,
And
taxes
that stuff.
for each of these 4 types, and then lay out a practical strategy based on age so you know which tool fits which job.
Sounds good. And let's start at the absolute beginning. The fundamental difference in investing. Owning something versus just lending money.
Perfect. So stock versus bonds. Stocks first.
Yep. Stocks mean ownership, equity, right?
Yeah.
You buy a share, you own a tiny piece of that company.
And the goal is usually profit. Capital gain, they call it.
Primarily, yes. You hold the shares, hope the company does well, and the share price goes up so you can sell for more than you paid. Dividends are possible too, but growth is often the main game.
Okay, but that growth comes with strings attached, right? Risk.
Huge strength. That pursuit of growth is exactly why stocks are, let's call them the high-risk engine in your portfolio.
High risk, high reward potential.
Exactly.
Yeah.
Historically, you look at something like the S&P 500, the returns have been pretty aggressive, around 9.7% annualized over the, last couple of decades or so.
Wow. Okay.
But that growth comes with serious ups and downs, volatility.
So what happens if the company doesn't do well, if it goes bankrupt? Where does that leave you? The shareholder?
You are dead last in line. Ouch, seriously. This is a key thing people miss. If a company goes under, the lenders, the bondholders, they get first dibs on whatever's left.
Okay.
Stockholders. As owners, you usually get wiped out, maybe pennies on the dollar, if anything. That default risk is precisely why the potential returns have to be higher, to compensate you for taking that chance.
Got it. So that's stocks. Ownership, growth potential, high risk. What about bonds then?
Bonds are the flip side. Pure debt. You're not an owner.
You're a lender.
Exactly. You're lending money to a company or maybe a government, like buying a U.S. Treasury bond.
And the goal here isn't really growth, is it?
Not primarily. The goal with a bond is fixed income, predictable, regular interest payments. They call it the yield.
So predictability instead of high growth.
That's the trade-off. You
Yeah.
get that stability,
Hmm.
but the returns are generally much lower. Remember that 9.7% for stocks?
Yeah.
Well, the U.S. aggregate bond index over the same rough period,
Yeah.
closer to 4.1%.
Big difference.
Huge.
You mentioned stability, but the sources kept talking about bonds as ballast. Why is that specific term important? That inverse relationship they seem to have with stocks.
Ah, yes, the ballast idea.
Yeah.
That's absolutely crucial for diversification. It's maybe the most important reason to hold bonds.
Okay.
See, we don't own bonds expecting them to shoot the lights out like stocks might. We own them because when stocks inevitably hit a rough patch, when the market panics and stock prices plunge.
Bonds tend to do the opposite, or at least hold steady.
Precisely. They often rise, or at least don't fall as much. They act like a cushion, a stabilizer. That ballast keeps your whole portfolio from sinking too dramatically during those sharp downturns. That's real diversification working.
Makes sense. It's not just about owning different things, but things that behave differently.
Exactly. And we should probably touch on taxes quickly, too.
Good point. How do they differ there?
Well, the interest payments you get from most bonds, that's usually taxed as ordinary income, which can be your highest tax rate.
Okay. Except for some types.
Right. The known exception is municipal bonds, issued by, like, states or cities. Their interest is typically exempt from federal income tax, which is a nice perk.
And stocks, when you sell for a profit.
That profit, the capital gain, is often taxed at lower long-term capital gains rates, assuming you held the stock for over a year. So potentially a tax advantage there compared to bond interest.
Okay, so we got the 2 main ingredients. Stocks for growth, higher risk. Bonds for stability, lower risk, income.
Building blocks.
But realistically, you don't want to go out and buy like 50 individual stocks and 30 different bonds yourself, right? That sounds like a full-time job.
Right. And incredibly difficult to manage. Which brings us to the baskets, Mutual funds, or MFs, and exchange-traded funds, ETFs.
These are ways to buy diversification easily.
Instantly. Both MFs and ETFs pool money from lots of investors to buy a whole collection, a basket of underlying stocks or bonds. You buy one share of the fund, you own a piece of everything inside.
But they're not quite the same, are they? The way they're managed or traded?
No, there are key differences. A big one is management style. You've got actively managed funds.
Where a manager or a team is constantly buying and selling, trying to beat the market, right? Beat a specific benchmark index.
Exactly. They're making active bets. Most traditional mutual funds tend to fall into this category.
Any other style?
Is passive management. Index funds. These aren't trying to beat the market. They're designed to simply match or mimic the performance of a specific index, like the S&P 500.
Just track the market return?
Precisely. And most ETFs use this passive index tracking strategy, though you can find active ETFs and passive mutual funds too. It's just less common.
Okay, and how about actually buying them? You mentioned ETFs trade like stocks.
Yeah, that's a huge practical difference. ETF trade on stock exchanges throughout the entire trading day. Their prices fluctuate constantly, just like an individual stock.
So you can buy or sell them anytime the market's open.
Right, and you can often buy just one share.
Yeah.
So the barrier to entry is really low, no big minimum investment usually.
And mutual funds?
Structurally different. They don't trade during the day. Their price, the net asset value or NAV, is calculated only once per day.
After the market closes.
Correct. So if you place an order to buy or sell a mutual fund during the day, that order won't actually execute until the market closes and they calculate that final NAV. Everyone gets the same price for that day.
No intraday trading then, and they often have minimums.
Yeah, traditionally they've often required a higher minimum initial investment, maybe a few $1,000s, though that's changing somewhat.
Okay, so passive versus active, trading differences. What about cost? This seems like a big deal in the sources.
Oh, it's massive. And frankly, favoring low-cost passive funds, whether they're ETFs or index mutual funds, is probably one of the single most reliable ways you can boost your long-term returns.
Just by not paying unnecessary fees.
Exactly. Avoid the drag of high costs. And this is where ETFs really shine, generally speaking.
How much lower are we talking?
Well, the key number is the expense ratio. It's the annual fee. In 2024, the average expense ratio for a plain vanilla index equity ETF was like 0.14%.
Okay, very low.
Tiny. Now compare that to the average actively managed equity mutual fund. That was around 0.4%.
Doesn't sound like a huge difference. 0.14 versus 0.40.
It sounds small.
Yeah.
Pennies on the dollar, right? But compound that difference over 20, 30, 40 years of investing. It adds up to a serious amount of your potential return just disappearing into fees.
Right, the compounding effect works on fees too, just in reverse.
Precisely. And it gets worse for some mutual funds.
How so?
Beyond the expense ratio, some mutual funds slap on other fees. You might see sales loads.
Like a commission for buying it?
Yeah, a one-time fee, sometimes paid up front, sometimes when you sell. Legally, they can be as high as 8.5%, although that's rare now. Many are no load, thankfully.
Still something to watch out for.
Definitely. And then there are annual 12b1 fees.
What on earth are those?
They're basically fees used to pay for the fund's marketing and distribution costs.
Yeah.
Kind of weird, right? You're paying them to advertise to other potential investors.
Huh.
ETFs, they're always no load. And they don't charge those 12b1 fees. It's just a structurally cleaner, cheaper way to hold the same underlying assets most of the time.
Cheaper is good. But the sources also made a really interesting point about taxes, especially if you're investing outside a retirement account, like in a regular brokerage account.
Ah, yes. Tax efficiency. This is where ETFs often have another pretty significant advantage over traditional mutual funds.
Why is that? How does it work?
Okay, it gets a little technical, but the basic idea is about how funds handle investors pulling money out redemptions.
Right.
With a traditional mutual fund, when lots of people want their money back, the fund manager often has to sell some of the underlying stocks or bonds inside the fund to raise cash to pay those departing investors.
Makes sense. They need the cash.
But what happens when you sell an appreciated asset?
Uh-oh. Capital gains. Taxes.
Bingo. Selling triggers capital gains. And here's the really, really annoying part for mutual fund investors. Those capital gains are then distributed out to all the remaining shareholders in the fund.
Wait, even if I didn't sell any of my shares?
Even if you personally held tight and didn't sell a thing, you can still get hit with a tax bill because of what other investors did. It's called a taxable capital gains distribution.
That feels kind of unfair. My tax bill depends on other people selling.
It does seem counterintuitive, does
Right.
it? And ETFs largely sidestep this problem. They
How?
use this unique mechanism. It's called in-kind creation and redemption.
In kind, meaning not cash.
Exactly. Instead of the fund manager selling stocks for cash to meet redemptions, which triggers the tax, large institutional investors swap big blocks of the ETF shares directly for a basket of the underlying stocks, or vice versa.
So assets are just swapped, not sold for cash within the fund itself.
Right. It happens between the ETF provider and these big players called authorized participants. Because the fund itself isn't constantly forced to sell appreciated securities to raise cash, it generates far fewer internal capital gains.
And fewer capital gains distributions passed on to me, the individual investor?
Precisely. Which makes ETFs generally much more tax efficient
Yeah.
if you're holding them in a taxable account. It's a huge structural plus.
Okay, wow. So cheaper and often more tax efficient. That's pretty compelling for ETFs as the default basket.
For basic broad diversification, absolutely. Especially passive index ETFs.
So let's pull this all together for the listener. We have the tools, stocks for growth, bonds for stability, and low-cost ETFs as maybe the preferred way to hold them. How do you figure out the right mix?
Right. It really comes down to two main things.
Sure.
Your time horizon, how long until you need the money, and your risk tolerance, how much volatility can you stomach?
And the main driver is usually time horizon, right? Which often correlates with age.
Generally, yes.
Yeah.
There's a classic rule of thumb, you've probably heard of it, the rule of 100.
Subtract your age from 100 to get your stock percentage.
That's the old version. Because people are living longer now, our sources suggest updating that. Maybe use 110 or even 120 as the starting number.
Okay, so rule of 110, let's say. Subtract your age from 110.
And that gives you a rough percentage to hold in higher risk growth assets, primarily stocks. The rest goes into lower risk stuff like bonds and other fixed income.
Let's walk through that. Someone in their 20s or 30s, using the 110 rule.
Okay, 110 minus, say, 30 is 80. So maybe 80% stocks, 20% bonds, or even 90-10 if you're 20.
Why so aggressive?
Time. You have decades before you'll likely need this money for retirement. Decades for compound growth to work its magic. A $10,000 investment at 25, earning, say, 6% annually after inflation, could grow to over $100,000 by age 65.
So you can afford to ride out the inevitable market downturns along the way.
Exactly. Volatility is the price you pay for those potentially higher long-term returns. This is your prime growth accumulation phase. Be aggressive.
And this is also where that idea of individual stock investing might come in, right? Not trading, but long-term investing.
Yes, good point. While low-cost indexing with ETFs is mathematically sound and simple, if you're young, have a high-risk tolerance, and you enjoy the research,
You might try picking individual stocks.
you might allocate some portion to it. It's much higher risk, requires serious effort to find truly exceptional companies. But the potential upside, if you pick a massive winner early on, is theoretically unlimited, way beyond index returns.
But most people who try to trade lose money.
Absolutely. We're talking long-term investing here, holding for years, believing in the company. Not day trading. That's a different, much riskier game. Indexing is the safer, more reliable path for most.
Okay, so fast forward. You're in your 40s or 50s, careers established, maybe kids, mortgage.
Right? Time horizon is shrinking a bit. Your ability to recover from a major market crash is less than when you were 25. So the rule of 110 might suggest 110 minus 50 is 60. Maybe 60% stocks, 40% bonds.
Still growth-oriented, but dialing back the risk.
Exactly. You start adding more high-quality investment-grade bonds. The focus also shifts more towards how much you're saving.
Yeah.
Max out those 401ks, maybe catch-up contributions if you're eligible.
Makes sense. Preservation starts to become more important.
It does. And then finally, you hit your 60s and beyond, approaching or in retirement.
Now the game really changes.
Completely. Using the 110 rule? Well, what 110 minus 65 is 45. So maybe you're looking at closer to 50% stocks, 40% bonds.
There's the last 10%.
That might be in cash
Yeah.
or cash equivalents.
Okay.
Things like certificates of deposit, CDs, or money market accounts. Very safe, very stable.
Why the cash allocation?
Income stability and capital preservation are paramount now. You're likely starting to withdraw money, not just save it. You need readily available funds that won't drop significantly if the market wobbles. Protecting your principal is key.
So the allocation gets progressively more conservative as you age. Less stock, more bonds, and cash.
That's the standard glide path, yes.
And now for someone listening who thinks, wow, that sounds like work, rebalancing all the time, is there an easier way?
Yes, there absolutely is. For those who want the ultimate set-it-and-forget-it approach, you have target date funds, or TDFs.
How do those work?
Super simple. You pick a fund with a year in its name, that roughly matches when you expect to retire, like a target date 2050 fund.
Yeah.
That fund automatically does the age-based allocation for you. It starts out aggressive, heavy on stocks, when the target date is far away, and then it automatically gradually shifts towards more conservative assets, bonds and cash,
Sure.
as you get closer to that 2050 target date.
So it follows that glide path automatically?
Exactly. Built-in diversification and risk management that adjusts over time. Very convenient, though you should still check the fees and underlying holdings.
Great shortcut for many people. Okay, let's wrap this up. We've covered a lot. Can we distill this down into, say, 3 actionable takeaways? Things someone can do, like today or this week.
Absolutely. Let's try 3.
Okay, actionable tip number 1.
Set your foundational ratio. Decide on that rule 100, 100, 120, minus your age, whatever feels right for your risk tolerance. Calculate your target stock bond allocation. That's your baseline. It defines your overall risk profile.
Got it. Know your target mix. Tip number 2.
Be absolutely ruthless about fees, seriously. For your core holdings, your broad market exposure, strongly favor those low-cost, passively managed index ETFs or index mutual funds.
Avoid the active management fees, the potential sales loads, the 12B1s.
Yes. Don't pay for active management unless you have a very compelling reason to believe it will consistently outperform after fees, which is incredibly hard to do.
Yeah,
Keep costs low. That's money in your pocket.
makes sense. And the final one, actionable tip 3.
Know your tax situation. Specifically, if you are investing in a regular taxable brokerage account, not an IRA or 401k, lean towards holding ETFs rather than traditional mutual funds.
Because that in-kind creation redemption magic.
Exactly. It generally makes them far more tax efficient. You're less likely to get hit with those unwanted capital gains distributions year after year. It can make a real difference in your after-tax returns.
Perfect. Set your ratio, watch the fees, and be smart about taxes with ETFs and taxable accounts.
That's a great summary. We really did cover the core DNA. Stocks for growth, bonds for stability, and those efficient ETFs often being the best way to package them for easy, low-cost, tax-smart diversification.
And that diversified mix, that stock bond allocation, is really key to having the fortitude to stay invested when markets get crazy, isn't it?
It's crucial. It helps smooth the ride. But
Yeah.
here's maybe a final thought to leave people with, building on what we discussed earlier.
Okay.
While that dependable, efficient, low-cost indexing approach is fantastic
Mhm.
and probably right for the core of most portfolios, there's still that allure, isn't there?
The allure of finding the next big thing, picking individual stocks.
Right. The potential, however risky, for truly life-altering growth if you can identify those exceptional companies early on. Plus, maybe the intellectual challenge, the fun even, of trying to beat the market.
So the question for you, the listener, is,
How much of your valuable time, your mental energy, and your capital are you willing to dedicate? Will you stick primarily with the proven efficiency of index funds? Or will you carve out a portion for that concentrated, high-effort, potentially high-reward pursuit of finding those individual winners?
a fascinating question. Where do you draw the line between dependable efficiency and the potential excitement of concentration? Something to think about.